All right, today we're tackling one of the biggest and, let's be honest, most controversial topics in trading: smart money concepts, or as you probably know it, ICT. Is this some kind of secret code to the markets, or is it just really, really good marketing? Well, let's dive in and find out. So let's kick things off with a really basic question. Have you ever just stared at a price chart, with all those wild spikes and dips, and thought, is this whole thing just random? Does it feel like pure chaos with absolutely no rhyme or reason behind it? While the whole idea behind ICT and smart money concepts is a big no to that question, the theory is that it's not random at all, that underneath all that noise, there's actually a hidden script being played out, a logic that's being driven by the biggest players in the entire game. And that right there is the core idea of smart money concepts. It's not about trying to fight the market. No, it's about figuring out who's really moving the market and then learning how to trade right alongside them, like you're riding their coattails. So here's the theory in a nutshell. Massive institutions, we're talking big banks, hedge funds, they don't just trade in the market, they actually strategically manipulate it. They'll push prices to very specific levels to hunt for stop losses, basically creating a pool of orders they can use to fill their own huge positions. The whole goal for a trader like you or me is to learn how to spot their footprints in the charts. But to see those footprints, you kind of have to learn their language. So let's break down some of the key jargon. Honestly, once you get these terms down, the charts can start to look completely different. Okay, first up is a huge one: liquidity. Just think of liquidity as the fuel that makes the market move, and it hangs out in really predictable places. Usually, it's a big pile of stop-loss orders sitting just above old highs or just below old lows. The theory is that smart money intentionally drives the price to these zones to trip those stops and get the volume they need to fill their own gigantic orders. Next up, we've got the order block. This sounds complicated, but it's pretty simple. It's just the very last up candle right before a big, sharp drop, or the last down candle before a huge rally. ICT traders look at these as the footprints left behind by the big institutions. They're zones where massive orders were likely placed, and if the price ever comes back to that spot, you can probably expect a pretty strong reaction. All right, then you have something called a fair value gap, or FVG for short. This happens when price moves so fast, so aggressively, that it leaves behind a kind of inefficiency, a literal gap on the chart. And these gaps, they act like magnets. The theory says that the market often hates leaving these gaps open and will eventually come back to rebalance or fill them in. And you'll often see these FVGs created by that powerful move away from an order block we just talked about. And finally, let's talk about the break of structure, or BOS. This one is super straightforward. Let's say the price is in an uptrend and it smashes right through a previous high. Well, that's a bullish BOS. It's basically a confirmation signal that the big money, the institutional momentum, is still pushing that trend forward. Okay, so we've got the lingo down. We know about liquidity, order blocks, and all that, but how does this all fit together on a typical trading day? Well, that brings us to a really practical model that ICT followers use called the power of three. The power of three, which is also called AMD, basically suggests there's a daily rhythm to the market. It starts with number one, accumulation. This usually happens during the quiet Asian session. The big institutions are thought to be quietly building up their positions. Then, number two, as London opens, you often get the manipulation. This is that sharp, fake move that's designed to hunt stop losses, either above or below that Asian range. It's the classic stop hunt. And finally, number three, fueled by all that liquidity they just grabbed, comes the distribution. This is the real directional move for the day, and you often see it play out during the New York session. Now look, as popular and widespread as these ideas are, we absolutely have to talk about the other side of the story. There is a lot of controversy and skepticism around all of this, and it's really important to look at why. And this really gets to the heart of the debate. On one side, you have people who say ICT is this revolutionary method for reading what the institutions are doing. But on the other side, you have critics who argue that, hey, a lot of these ideas are just rebranded concepts from the Wyckoff methodology, which has been around since the 1930s. And while followers swear it gives them a unique edge, the critics fire back with a really tough question. Where's the proof? Where are the independent, verified track records showing this actually works better than anything else? You see this sentiment all over trading forums and discussions, and it really captures the core of the skepticism. The idea that the loudest voices are usually the ones selling courses, not the consistently profitable traders. It points to this concern that maybe the business model here is more about selling education than it is about successful trading. So to just quickly recap the main criticisms you'll hear, first, there's a real lack of verifiable long-term track records from the big names in this space. Second, many people question if the main business is actually trading or if it's selling courses. Third, you just don't see any data from independent prop firms showing that ICT traders are outperforming everyone else. And finally, you hear a lot of stories from former students who say they really struggled to find any kind of consistency with it. Okay, so we've looked at the concepts, we've looked at the controversy. Where does that leave us? How should you or I think about these ideas? What's the final takeaway here? So, what's the verdict on smart money concepts? Is it the secret sauce to the markets, or is it just clever marketing? The most balanced take seems to be that it's a really powerful framework. It's a lens for looking at price action. It gets you thinking about liquidity and market structure in a way that most retail traders just don't. And that's valuable. But, and this is a big but, it is not a crystal ball. It is not going to predict every single move with perfect accuracy. And you know what's interesting? When you strip away all the arguments and the debate, both the biggest fans and the harshest critics usually land on the exact same truth. A trading strategy, any trading strategy, is completely and utterly useless without rock-solid discipline and strict risk management. That's the one thing everybody can agree on. And that really brings us to the final and maybe the most important question of all. Maybe this whole hunt for a holy grail strategy is missing the point. Because the real question isn't whether the strategy has an edge. The real question is, do you have the discipline to execute any strategy, day in and day out? That, right there, might just be the real secret.